Stock prices. It is an unfortunate fact that great and foolish excess can come into prices of common stocks in the aggregate. They are valued partly like bonds, based on roughly rational projections of use value in producing future cash. But they are also valued partly like Rembrandt paintings, purchased mostly because their prices have gone up so far. This is very interesting, and it belies several of the underlying thought processes that have made Charlie so incredibly wealthy. First, the bond piece. Some companies, not all, but some have businesses that create fairly consistent earnings and earnings growth. Charlie and Warren believe that the common stock in those special businesses can be valued like bonds. So if a company is earning $1 a share and the stock is selling at $10 a share, one can argue that the stock is like an equity bond that is earning 10%. If the company's earnings are growing at 5% a year, our two boys can argue that they just bought an equity bond that is earning 10% a year and growing at 5% a year. They think of it as an equity bond with an expanding rate of return, which, over time, lifts the underlying value of the company and thus its share price. The Rembrandt painting analogy refers to the fact that the market for old masters' paintings is driven by demand, and demand is often determined by how quickly selling prices are rising or falling. The same thing can happen in stocks. A fast rising price can attract more buyers, just as a fast falling stock price can attract more sellers. When an asset bubble bursts and demand for equity instruments evaporates, people sell their Rembrandts and stocks for whatever they can get for them because they are desperately in need of cash. For Charlie and Warren, the time to buy the equity bonds of a wonderful company is when everyone else is trying to sell their Rembrandts.